Hi everybody, it's Mark Latham from Commodity Intelligence. This is our first weekly video log of 2019. It's a new idea, we thought. Just a quick summary of what we've said and done during the week. Keep it simple, keep it short, keep it sweet, and keep it focused. So, first issue, has anybody noticed liquidity? The central banks, this is random chart I found on the web, central banks have been taking the alcohol from the cocktail party. Very mean of them. Means we don't have to have any party anymore. Not fun. So you can see a big contraction in liquidity here. Not very nice. That happened just as the party was beginning to go strong. You see this blue line rising, that's real activity strong. So no alcohol, lots of dancing, people get annoyed. Result, stock market falls off a cliff, ouch. So that P's come rattling down actually, because you've got strong profits, weak liquidity, market looks cheap. So this is the cheapest trade that you're ever going to see the stock market look. Here's the anomaly. Commodities were plunging during the sell-off. Last time this happened in 1984, yeah. And then the Fed raised rates to 12.5%, and inflation was about 4.5%. So we had interest rates about 3 times the level of inflation. Not surprisingly, didn't do a lot of good for the economy. Didn't do a lot good for the stock market, and not fun. Same situation today. Just want to move across to oil quickly. Look, basic picture in oil is really simple. Shale versus Saudi. Here's the shale. Here's Texas oil production at record high, 5, probably going to 10. Here's Saudi, here's Ghawar, the biggest field. It's 5, going absolutely nowhere. At some point, Ghawar is going to turn down because they've got about 70% of the oil out of that field. There's only about 30% left. So as soon as oil production starts going down, I'll probably turn bullish on oil, but that's not now. Wait, too early to buy this oil cycle. Here's coal. Coal really scares me. In the old days, they moved coal from the east, from the west to the east, then put it in a ship and move it down to Shanghai. So if I go over to this side, that way, you can see Shanghai in the big sort of red blobs. So here's what's happening today. They take coal from up here in Mongolia, and it goes straight on a bunch of railways southeast directly down to Shanghai. And that's shorter, because before I was going Inner Mongolia, Guangzhou, onto a boat down to Shanghai. So that was about $75 of costs. Now, gone down to about $50 of costs. So that means that internal coal is much more competitive. That means the low on the next coal cycle is much lower. That means the downside risk in coal is much higher. So as a result, biggest cap coal company I can think of is Glencore. $2.5 billion of EBITDA coming from coal, about roughly 1/3 of their current EBITDA this year. Not good, so we put that one on a short. That was kind of our big call of the week. General point, just to summarize, stocks are cheap. Everything's cheap in my sector. I put Micron in here just for comparison, by the way. Micron's on 2 times EV/EBITDA, which is worrying because they're on 2 times EV/EBITDA. They've got a tremendous free cash flow yield here, about 10% historically. possibly even higher, possibly even as high as 25% free cash flow yield right now. Huge stock buyback program, and the stock's in the bear market. Very difficult to get bullish again of our miners and chemical companies when I got Michael and trading like that. That's sort of a bit nasty. Here's Alcoa, by the way, which I got all wrong. Anyway, it's really cheap, but hopefully we'll find some entry point back into that one. Anyway, enough. That's it for the week. See you next week.